Imagine a world where your job isn't taken by a person in another country, but by a line of code that costs less than your morning coffee. Right now, a company with the employee count of a mid-sized town is outperforming industrial giants that have stood for a century. Meta, a titan of the digital age, just announced it will cut 8,000 jobs. That's a staggering 10% of its total workforce slated for this coming May. But this isn't just a corporate restructuring, it is a desperate pivot as the AI shift accelerates. While traditional sectors struggle to maintain a 2% growth rate, AI-integrated firms are seeing productivity spikes that defy logic. This creates a terrifying divergence, a tech elite soaring on efficiency, while the broader labor market faces a displacement event we haven't seen since the Industrial Revolution. If you think your white-collar degree is a shield, you need to look at the data coming out of Silicon Valley. We are witnessing the birth of a new economic reality, where human labor is becoming the bug in the system rather than the feature. This isn't just about software, it's about a fundamental rewiring of the global economy that mirrors the most volatile periods in financial history. Are we looking at a new era of prosperity, or are we sleepwalking into a structural recession that will make 2008 look like a minor correction? The signs are everywhere, from the boardrooms of Menlo Park to the currency exchanges of London. We have to ask, is the current AI boom actually a sophisticated liquidity trap? To understand where we are going, we have to look at the shadows being cast by the giants of the past and the underdogs of the future. The data tells a story of a world divided, and the gap is widening every single day. If you have a savings account or a 401k, the next 10 minutes will explain why the ground beneath you is shifting. We are tracking a chain reaction that starts with a single line of code and ends with the potential collapse of the modern middle class. This is the story of the Great Displacement, and the numbers are more clinical than you could ever imagine. While the headlines focus on ChatGPT, the real story is in the bond markets and the layoff notices. We are entering a phase where the speed of change outpaces the speed of policy. It's a race between silicon and soul, and right now, the silicon is winning by a landslide. The last time the market felt this disconnected from reality was right before the floor fell out. We are seeing a synchronized spike in recession sentiment that matches the real sector contraction with haunting precision. This is the echo of 1987, but this time, the machines aren't just trading the stocks, they're doing the work. The ghost of October 1987, is haunting the glass towers of Wall Street once again. On that single day, known as Black Monday, the Dow Jones Industrial Average plummeted by over 22%. What caused the 1987 stock market crash? It wasn't a war or a famine, it was the dawn of programmed trading, primitive algorithms that created a feedback loop of selling. Let's fast forward to 2026, and we're seeing a terrifyingly similar pattern, but with a modern twist. Today, it's not just algorithmic trading causing volatility, it's algorithmic displacement. When Meta announces it is cutting 8,000 jobs in a single month to lean into AI, they are sending a signal to every other CEO on the S&P 500, human capital is now a liability. Anthony Scaramucci, a man who has lived through more market cycles than most, now openly states he believes a US recession is not just possible, but likely. Even Fidelity's latest recession guide has moved its indicators into the late cycle red zone. This creates a fascinating but dangerous paradox. While tech stocks might soar on the news of increased efficiency from layoffs, the broader economy enters what economists call a liquidity trap. If 10% of the high-earning tech workforce is suddenly sidelined, consumer spending takes a hit that no amount of AI-generated productivity can immediately replace. Look at the British pound. The Great Britain currency is experiencing a sudden spike in interest and volatility. Why? Because when the US tech sector sneezes, the global currency market catches a cold. Investors are fleeing to the pound and other assets in a desperate search for a safe haven as they realize the US economy might be over-leveraged on an A promise that hasn't yet paid out in broad-based GDP growth. Historically, when we see this level of divergence between tech valuations and labor market stability, a correction is inevitable. Think back to the COVID-19 era. Massive liquidity was injected into the system, which Lars Christensen notes pushed financing costs for AI companies below the natural rate. This created a Hayekian malinvestment. We've built a giant tower of AI capability on a foundation of cheap money that is now drying up. The IMF is now warning that AI could impact 40% of global employment, but in advanced economies like the US and UK, that number jumps to 60%. We aren't just talking about factory workers anymore. We are talking about lawyers, analysts, and coders. This is the displacement doom loop. Companies cut people to save money, which reduces aggregate demand, which leads to more cuts. While some argue this displacement is overstated, the real-time data from Meta suggests the future is happening right now in May 2026. If Meta is the canary in the coal mine, then the mine is rapidly filling with carbon monoxide. But here is the real question: if the machines are doing all the producing, who is left to do the consuming? This is the fundamental flaw in the current market logic. We are valuing companies based on their ability to remove the very people who buy their products. The last time we saw such a rapid shift in the means of production was the transition from steam to electricity, but that took 40 years. AI is doing it in 40 weeks. This speed is the black swan of our generation. The 1987 crash was a liquidity crisis caused by fast machines. The 2026 crisis might be a demand crisis caused by smart machines. Even the European Central Bank is sounding the alarm, noting that while AI offers efficiency, it introduces systemic risks that central banks aren't equipped to handle. When the ECB and Scaramucci agree on the danger, it's time to pay attention. We are seeing a flight to quality that is driving the British pound into territory we haven't seen since the post-Brexit stabilization, but this time it's a hedge against a failing Silicon Valley narrative. The modern liquidity trap is here. We have all the technology in the world, but the wealth is concentrating so fast that the velocity of money is slowing to a crawl. If money doesn't move because people don't have jobs to spend it, the entire engine stalls. This is how a tech boom becomes a structural recession. We are watching a high-stakes game of musical chairs, and the music is being composed by an eye that doesn't need a seat. The tension between the smarter economy and the human economy is reaching a breaking point. Every job cut at Meta is a data point in the larger trend of hollowing out the middle class. While the top 1% of AI researchers see their salary soar to $1 million plus, the average software engineer is looking at a 15% decline in entry-level openings. This isn't a theory, it is the reality of the 2026 labor market. We are building a world that is incredibly efficient at producing things for people who can no longer afford them. This is the echo of 1987, a market that has moved so far ahead of the humans, it serves that it eventually has no choice but to collapse back to reality. If you are waiting for a sign, the Meta layoffs are the siren. The currency shifts are the tremors. The question is no longer if a displacement-led recession is coming, but how deep the crater will be when it finally hits. We are in the middle of a massive experiment with no control group, and the data is coming back negative. As we look ahead, the implications are staggering. We are standing at a crossroads where the efficiency of the machine meets the necessity of the human. The echo of 1987 reminds us that markets can remain irrational longer than you can remain solvent, but they eventually return to the mean. The modern liquidity trap, fueled by AI displacement, suggests that our traditional tools for fighting recession, like lowering interest rates, might not work this time. If the problem is that people are being replaced by software, making it cheaper to borrow money won't bring those jobs back, it will only make it cheaper for companies to buy more software. This leads us to a startling conclusion. We may need to redefine what value even means in a post-labor economy. Are we moving toward a future of universal basic income or a new feudalism where the owners of the AI models hold all the cards? The spike in British pound interest shows that the world is already looking for an exit strategy from the tech-heavy dominance. The next few years will be a period of unprecedented volatility. The underdog in this story isn't a small country, it's the human worker, fighting for relevance against a giant of our own making. If we don't find a way to reintegrate the displaced into the value chain, the 1987 crash will look like a minor blip compared to the structural reset that awaits us. The data is clear, the warnings are loud, and the clock is ticking. Will we adapt, or will we let the echo of the past become the soundtrack of our future? The answer lies not in the code, but in the choices we make today about the world we want to inhabit tomorrow.